We are live with another Quick Tip Tuesday, each and every Tuesday at 8 p.m. Eastern Time. This week's topic, began a lot of notification, a lot of questions regarding my clients regarding DTI. What is DTI? DTI is very, very important when it comes to a mortgage. When a loan officer or any mortgage rep is trying to qualify you for a home to see what you qualify, they're calculating your DTI. That's the most important. DTI is debt to income ratio. It basically means how much money is coming in, how much money is coming out, whatever's left over, what can be put towards the mortgage. So a lot of things can impact DTI. There's many different loan products out there. So depending on which loan product you prefer, you can definitely will be impacted on what you qualify for. So for instance, FHA, you typically will qualify for more versus conventional loan, depending on how much you're putting down. So that definitely takes a big role. But if you're trying to put the minimum down, let's go with the minimum for each loan product. FHA, you typically can qualify for more because of their percentages. They allow you to have a higher percentage on your debt to income. What does that mean? So for instance, FHA, it will allow you to have a higher mortgage payment with the income you have. So for instance, you can have maybe a $2,300 mortgage payment and you can qualify FHA, but for conventional, it'll probably be around $2,000 possibly, depending on, give or take, depending on the house. So for instance, a very good example is, let's give a person making $60,000 a year. Let's say they have little to no debt. The way it's calculated is on a monthly basis. So 60,000 divided by 12, that is 5,000 a month. So there's something that's 5,000 a month. So your debt to income ratio would be 5,000 a month. You can only qualify for about a $2,300 mortgage payment. To put that into perspective, that would be about a $300,000 home with about $10,000 in taxes and just an insurance of about, let's say, average $1,200 a year. So all in, your mortgage payment will be about $2,300, and you can qualify FHA for that with the minimum down payment. That same loan, you will not qualify for conventional. So that's why the ratios are a little different for each loan product. So it's good to understand what you qualify for each loan product if you want to go that route, if you want to maximize your actual income and qualify for the most. FHA would be your best option. But if you're able to put more down payment and can get rid of mortgage insurance and your credit is good, maybe conventional would be the best product for you. But it's good to understand what you're working with. Because a lot of times, maybe a loan officer, mortgage rep that you're talking to, they're maybe not explaining it good enough, or sometimes it's tough to understand because every day someone's in real estate, it's sometimes hard to take it down a notch and really explain it step by step. So it's good to have an understanding on your end, how much money you have coming in, how much money you have coming out. So a good part of understanding that, there's something called a front ratio and a back ratio. So for that example of the $6,000 a year, the mortgage payment is about $2,300. That's your front ratio. Let's say you have a high debt. Let's say you have regular to no debt. So the maximum allowed of your back ratio would be about $2,800. So basically what that means, your $2,300 mortgage payment, and you can only have a maximum debt of $500. So that would be any student loans, car payments, any credit cards, all of their debt would have to be $500. And if you're in forbearance, keep in mind there still had to be some type of payment. So speak to your rep, they will better explain exactly what type of payment will be there. So that would be your what you qualify for, about $300,000. But let's say you have more debt. You have more than 500. Let's say you have 1,000. So now that would impact what you qualify for. You wouldn't qualify for 300 anymore. That would probably decrease to about 250, 240, 230, depending on the taxes. So that's why it's very important to understand your front ratio and your back ratio, because the back ratio, how much debt you have, can impact your actual what you qualify for a mortgage. So if you have high debts, sometimes it may be good to possibly pay some debt down, depending. Or the good thing about FHA, it allows you to buy a multifamily. So now with that 60K down, with that 60K income, instead of being 60K, you can actually use potential rental income you're going to get from the other units to qualify for a higher property. So right now, instead of 300,000, now your income is higher. Your debt to income ratio decreases because you have a higher income. You can qualify for about, let's say, 350, 375, maybe even 400 for a 2-family home, depending on the rents in that specific area you're looking for. If you jump into a 3-family, you're going to 400, 425, 450. If you go to a 4-family, you're closer to 500. So that's why it's always good to possibly get into multifamily, because 1, you can qualify for more. 2, you can definitely help if you have high debt. That can help with your ratios. I see a few questions, so I'm going to slow it down and answer them. Can I do anything to get a lower front ratio? That's a good question. So there's a few things you can do. Multifamily is number 1. You can qualify for a higher amount if you get a multifamily. You can get cheaper insurance because the front ratio includes the principal, interest, tax, and insurance, so your entire mortgage payment. So if you get cheaper insurance, that would help with your front ratio. You can buy down some points and get a lower rate. Rate will impact your front ratio as well. You can add someone to the loan. That would help with your front ratio. So there's a lot of things to tweak around with that would help with your front ratio. Some exceptions can be car leases too, correct? Depending on how much you have left in your lease. Not sure if anything has changed. So with leases, you really can omit a lease payment unless you're co-signing for someone else, a co-borrower, and that other person has made 12 consecutive payments, and to confirm that you're basically not obligated and the other person is basically paying. But when it comes to financing a car, usually 10 payments or less, you can omit that payment because you're at the tip of the financing world of the actual car, and you're going to own that, and you won't have any payments after that. But when it comes to leases, you're basically going to get another car, and you're going to have another payment. So you're renting a car kind of. So when it comes to leases, it gets a little trickier. Only way around that is co-borrower. If someone else is on the loan as well, on the car lease, and they're making consecutive payments from their bank account. That's the only way around that one. Funny story. I had a borrower with 3 leases in his name, and we weren't able to omit any of them because he was the only borrower on that car lease. So do not get any cars or leases or any loans on your name, because don't do any favors, because that can impact what you qualify for a mortgage or anything really. So a few things I also want to touch base on DTI. Sometimes it's not good to maximize. So let's say your loan officer is saying that you qualify max for 300,000. I don't really recommend going for your max, because if your credit decreases, the insurance is high, so for some reason you make a late payment, for some reason you have a higher debt, you go open a new credit card, now you have a higher debt, that would eliminate you. So if your back ratio increases, that can disqualify you from the loan. So you're basically walking on eggshells. So just be careful. You can, but just be very, very careful on that. and it can impact the rate as well. So if you're maximizing your budget, it's riskier. You would possibly have a higher rate. You will have a higher rate. Can I add someone to help with DTI? Yes, you can. As long as that person is qualified in all parts, they have the income, the work history, they qualify on the credit side. So you definitely can add someone else. Just make sure they meet those criteria, and they have a better debt to income ratio. Because if you add someone and they have high debt, they can possibly impact your qualification. But if they have a strong income and lower debt, they can improve your ratios and what you qualify for. So that's pretty much it, what I wanted to discuss. I can probably take one more question before I wrap things up. So the debt you have can impact what you qualify for, so definitely keep that in mind. If you have high debt payments, if you have things in forbearance, don't assume that you can disqualify them and your debt to income ratio is low. No, the bank will have to make some type of payment, because sooner or later you would have to make payments on that loan. So keep that in mind, and don't assume on your income. I speak to a lot of borrowers. They assume their income is a certain amount, and then when I do the actual calculations, it can definitely be lower. So just be careful with that. Try to get some accurate numbers. Just ask away to your loan officer, whoever you're working with. If you have any questions, you can reach out to me. And you're welcome. Some great questions today. I'm going to wrap things up because I want to keep this short and to the point. If you have any topics for next week's Quick Tip Tuesday, please reach out to me. And hope everyone has a great rest of your Tuesday and rest of your week as well.